Hi, my name is Lisa Cummings, and today I'm going to share with you some information about cash balance retirement plans. First, I'd like to share a little information about Cummings and Cummings Law. At Cummings and Cummings Law, we are a full-service law practice. We focus on supporting clients in Florida, Texas, as well as Oklahoma. We support corporate clients as well as individuals for all needs relating to business transactions as well as individual legal processes. I also want to share just a moment about myself. I have spent my career working in the legal area, assisting corporations in planning their retirement programs, as well as assisting corporations from an employment law as well as executive compensation perspective. Now let's dive into cash balance plans. First, what is a cash balance plan? At a high level, a cash balance plan is a hybrid defined benefit plan that credits pay and interest to a notional account for employees. At the time that this amount is withdrawn, it can pay either a lifetime annuity or a lump sum payment. Typically, cash balance retirement plans are used by professional firms and closely held businesses to accelerate pre-tax savings for their employees, as well as provide the employees the opportunity to simultaneously participate in a 401k plan. So what is a cash balance plan? It truly is a qualified defined benefit plan. It has a cash account balance view. However, each year the employer is required to contribute a set percentage of pay as well as guarantee a credit interest for each of the participants in the plan. The employer bears the investment risk for the performance of the cash balance plan, not the employee. And at the end of the time the employee finishes working for the employee will be able to roll the remaining account balance into an IRA upon a job change. So why is there such an interest in cash balance plans right now? A couple of different reasons. First, high earners are seeking larger opportunities to have pre-tax dollars set aside for them in a retirement plan, as at the same time that tax rates from a federal and state and local perspective are impacting the overall tax margin that are experienced by these participants. Additionally, aging owners will value a 7 to 10-year window to allow their employer to supercharge their retirement nest egg for them before the individual exits or before a partial sale event. Additionally, stable interest crediting reduces the participant perception of market volatility relative to pure defined contribution plans. So what are some of the different design elements behind a cash balance plan? It's important to note that the employer is the entity which will make the decisions regarding a cash balance plan. Cash balance plans are ideal for professional practices such as medical practices, law practices, engineering firms, family businesses, in the event that those particular firms have a stable cash flow. So a cash balance plan does not work well for organizations which have a variability of their cash flow, which may have some years where they do not have additional revenue to be able to fund the particular plan. Some design levers in the cash balance plan include age-weighted pay credits, service-based tiers, as well as integration with the 401k plan to allow for federal tax testing relief. Additionally, the employee impact can be smoothed with minimum credits and clear communication about vesting and portability. Contributions and annual limits are set at the plan level by the employer. So the employer determines the pay credit amount, whether it's a flat dollar amount or whether it's a percentage of pay, by each employee group. The projected benefit funding will allow materially larger deductible contributions by the employer for older owners and principals. And then the actuary for the cash balance plan will set the funding range each year, and the sponsor, that being the employer, can target within the corridor based upon their cash flow and their funding goals. Some of the tax treatment and deductibility elements include the following. Contributions are generally deductible by the employer and are not taxable to the participants until distribution. Coordination of a 401k plan alongside a cash balance plan allows maximizing deductions while meeting federal non-discrimination rules. And then finally, large pre-tax funding can materially reduce pass-through K-1 income for LLCs which are taxed as a partnership. Why do high earners use these plans? These plans are valuable to employees who are high earners who would like the ability for their employer to turbocharge their retirement account. Contributions of up to $300,000 annually per individual, depending upon the individual's age, is possible. Additionally, there are significant tax deductions for the employers. This is ideal for a late career professional, as well as the fact that a cash balance plan has safe growth as well as portability for the plan participant. As an example of how valuable a cash balance plan can be, I'd like to give you a hypothetical situation of a 60-year-old physician working for an employer, and that physician's earning $400,000 a year. If the cash balance plan design is set correctly, and it includes the elements of the corporation such that all of the employees of the organization can benefit from the plan, it's potential that that physician could have $300,000 a year set aside for him in the cash balance plan by the employer. Note this is best suited for high earners who are nearing retirement. It works well for small businesses that have a steady cash flow. And one of the downsides to a cash balance plan is these plans require some administrative effort and cost, which means you'll typically work with an attorney to establish these, and they in turn will work with actuaries as well as CPAs to support all of the administration and the compliance work surrounding these. As an example, in this hypothetical, in this, you'll see the silver bars reflect the contribution amount annually by the individual into a 401k account, whereas the gold bars reflect the amount which the employer can contribute to a cash balance plan for the benefit of the employee. So for instance, down here at age 40, you'll see that the employee can contribute $23,500 to his or her 401k account. Depending upon the design and the demographic setup of the employer in a cash balance plan, the employer could set aside up to $80,000 in addition to the contributions that the employee contributed to the 401k plan. Compare that over here at age 60, such that you have an individual who's contributed $31,000, which is the maximum allowable under the IRS, plus the catch-up for those up to age 59 for a total of $31,000 contributed by the employee. And then, again, depending upon the setup of the cash balance plan and the employer's employees who will be participating in the plan, the employer could set aside an additional $300,000 into that 60-year-old's cash balance account. So what are some of the next steps and recommendations in considering a cash balance retirement plan? My first recommendation is to consult with an attorney who focuses on qualified retirement plans. That attorney can help you identify appropriate actuaries as well as record keeping vendors for the employer to consider and select. CPAs and actuaries will be involved in tailoring the plan design, which takes into account the employees at that particular organization and projected testing to ensure that the plan will meet all non-discrimination requirements. And then typically that cash balance plan will be combined alongside of a 401k for added flexibility. There also has to be compliance with IRS and PBGC requirements. And then annually, the employer will need to review alongside the actuary, the CPA, and the attorney the amount of the annual funding that should be required, as well as any additional interest credits which should be placed in the plan assets itself. What I'd like to do is encourage you to email me if you have any additional questions, or if you'd like to request a free ebook that I can mail to you. My email address is Lisa, that's Lisa, at cummings.law. Send me a note and I'll be happy to send over a free ebook which gives more detail about cash balance retirement plans. Thank you for joining us today, and you have a great day.